Okay, Barry, so if we were to zoom out to 30,000 feet here, now someone argued that this should be a real data point that pushes the Fed towards considering the kind of easiness of financial conditions overall and maybe holding off on rate cuts later this month. So how would you contextualize this for us?
Well, I think that there is a broader trend at play here as well, which is through the 2010s, we had two factors pushing down on consumption, particularly in the first half of the cycle. The first one was the deleveraging effect of the global financial crisis, the housing crash. The second one was the boomers, which is the second biggest age cohort, was in peak retirement savings mode.
Oh, interesting. Like accumulation, like they're trying to
correct.
accumulate.
So there's a life cycle wealth thesis, right? Like you spend most when you're in your, 30s and 40s, and then you spend less as you get close to retirement, saving for retirement. So that was putting downward pressure on consumption. So I had already had this thesis that consumption was going to be stronger this cycle than last cycle because the millennials, which is the biggest age cohort, are in peak spending mode.
Years, yeah.
I also view this as there's some justice.
By the way, I even saw a post recently that said the whole Piketty inequality thing was going to be proven incorrect because it didn't it didn't adjust by age. So if you do that study during the 2010s, you're not yet going to see the full spending that millennials are going to contribute, for instance, which actually narrowed some of those measures there. Anyway, go on.
Well, the other point I was going to make is there's some justice in all this, in as much as aggressive monetary policy created the origins of Bitcoin, and excessively aggressive policy in 20 and 21 caused house prices to go up 50% and make housing as unaffordable as it's been any point since the 80s. Right. But somehow that same factor drove up crypto prices, which created some wealth for that age cohort that they can use to buy houses. So markets have a way of sort of figuring all this
things
stuff out.
Yeah.
The point that you led off with about me thinking the Fed's got bigger problems than worrying about consumption boosting inflation. There's a lot of factors going on with inflation, goods price deflation coming out of China, and then whether we have something of an import price tax, tariffs, that sort of stuff. But for me, one of the issues we've been talking about a lot, Steve and I have talked about it, you and I have talked about it, is the disproportionate policy impact on small businesses and small banks, like a later guest you have,
who I
talked
really
to in the
made
green
this
room.
point. Yeah.
And Steve's been talking about this a lot. And so what I would like to see happen in 2025 is a whole of government approach. Powell in his Q&A with Andrew last week said, yeah, I'm going to sit down with the Treasury Secretary every week, just like we've been doing, it's been happening for decades. Well, what I think they should do is Besant should agree to extend the duration of his issuance, stop with all the bill issuance. That'll allow QT to run longer. So that tightens conditions for long-term fixed-rate borrowers, which includes housing, but ultimately I think that will help housing, and I'll explain why. But then that will improve small bank profitability. The Fed then cuts to, say, 3.25, sustainably disinverts the curve. Bank ROE for small banks is 5 right now. It's 10 for big banks and even higher for JP Morgan. You then reopen that small bank credit channel. You ease all the pressure on small businesses. NFIB will get their number tomorrow, but last month it was 9.7% is the average financing rate for small businesses. So you can distribute the tightening across the curve more equitably and rebalance growth.
My guess is all of this is going to happen. My guess is whether or not it's as coordinated as you say. Steve, what's your take as well? That we're probably going to see more rate cuts. It's going to help uninvert the curve. They're probably going to change the issuance to kind of lengthen it out a little bit. Again, I mean, don't you think this is probably slowly, perhaps, but the evolution that's going to take place, which would be bullish?
I think so. I mean, all of that would create a more normal kind of set of financial conditions where you do have financial conditions easing, which is interesting to me. If you look at the FCI, say for Goldman or even from the Fed, it is negative, which suggests there's a tailwind out there. It's not excessively easy right now, and I think part of it is the things Barry was talking about, which is that rates in the real economy are still relatively high, and Wall Street gets to benefit from this, not necessarily Main Street. I think it's worth thinking about the idea. I worry always about the kind of coordination you're talking about, unless we're in absolutely dire straits between Treasury and the Fed. So you want to be a little careful about that. I do think this crypto thing, though, together with other wealth issues, is something that's on the table and worth thinking about, especially when you think about the idea that we have no measures of how much it is.